Economic headlines suggest calm, inflation easing, market steady, growth forecasts intact. Yet beneath the surface, pressure is quietly building across debt, trade, housing, and labor. The global economy often doesn't break when shocks happen, it breaks later. This delay creates a dangerous illusion of stability. That illusion is called the lag effect. The global economy often appears stable precisely when underlying stress is accumulating, because economic systems respond to shocks with long and uneven delays. According to the International Monetary Fund and the Federal Reserve, policy actions such as interest rate hikes, fiscal tightening, or credit restrictions do not impact growth immediately. Instead, they work through the economy over months or even years, affecting investment, employment, and consumption gradually. This creates a lag effect, where indicators remain resilient even as conditions deteriorate beneath the surface. Businesses continue hiring based on past demand. Households spend using savings accumulated earlier, and governments rely on revenue trends that reflect yesterday's activity. OECD analysis shows that monetary tightening typically hits housing, construction, and business investment first, while labor markets respond last. As a result, unemployment often rises only after growth has already slowed significantly. Reuters reporting highlights that this delay can mislead policymakers and investors into believing risks have passed, encouraging complacency at precisely the wrong moment. Credit conditions offer another example. Banks may maintain lending standards initially, but as defaults rise and funding costs increase, credit tightens sharply and suddenly. By the time this shift becomes visible in data, economic momentum has already weakened. Global trade exhibits similar lags, with contracts and supply chains adjusting slowly to weaker demand. These delayed responses explain why economies often appear strongest just before downturns deepen. Stability in headline numbers does not mean stability in underlying dynamics. The lag effect masks fragility, allowing imbalances to grow unnoticed. When the adjustment finally arrives, it feels abrupt, even though the causes were building quietly for a long time. Understanding this timing mismatch is essential to understanding why calm periods often precede economic stress. If today's stability reflects yesterday's conditions, what hidden shocks are already in motion beneath the surface? One of the clearest examples of the lag effect is the delayed impact of high interest rates on the real economy. Central banks raised rates aggressively to fight inflation, yet growth in many countries has remained surprisingly resilient. According to the Federal Reserve and IMF, this resilience is largely temporary. Higher borrowing costs take time to filter through mortgages, corporate debt, government financing, and consumer credit. Many households and firms locked in low interest rates years ago, insulating them from immediate pressure. As those loans mature and refinancing occurs, costs rise sharply, squeezing cash flows. The Bank for International Settlements notes that this refinancing wall is one of the most underestimated risks in the global economy. Businesses that appeared healthy under cheap credit now face higher interest expenses that reduce investment, hiring, and expansion. Reuters reporting shows that small and medium-sized firms are already feeling the strain, even as headline employment numbers remain strong. Governments are also exposed. Public debt servicing costs increase slowly at first, but over time they crowd out spending and force fiscal tightening. Housing markets provide another lagged signal. Mortgage rates rose quickly, but transactions slowed before prices adjusted, giving the illusion of stability. Eventually, affordability constraints reduce demand, prices soften, and construction activity falls. These effects unfold gradually, often after central banks believe policy has already worked. The danger is that policymakers may stop tightening too late or ease too early, misreading lagged data. By the time the full impact of high rates appears, momentum has already shifted downward. This explains why recessions often occur well after inflation peaks. The economy does not respond instantly to tighter money. It absorbs the shock quietly until pressure becomes unavoidable. The lag effect turns policy success into delayed economic stress. If high interest rates are still working their way through the system, how much damage is already locked in but not yet visible? Strong labor markets are one of the main reasons the global economy appears stable, but employment data is among the most lagging indicators in economics. According to the IMF and OECD, firms typically delay layoffs until demand has clearly weakened, because hiring and training are costly, and uncertainty encourages caution rather than immediate cuts. Companies often respond to early stress by reducing hours, freezing new hiring, or cutting investment instead of shedding workers. This keeps unemployment low even as profitability and productivity decline. Reuters reporting shows that many firms continue operating with excess labor, hoping conditions will improve before making painful adjustments. This behavior creates a misleading sense of resilience in employment data. Another distortion comes from labor hoarding, where companies retain workers despite weaker output to avoid future hiring difficulties. This phenomenon has been especially visible after recent labor shortages, reinforcing the illusion that the economy is strong. OECD analysis highlights that wage growth can also lag downturns, supported by contracts and bargaining agreements signed during better times. As a result, consumption remains temporarily strong even when underlying business conditions deteriorate. Eventually, however, pressure builds. When firms can no longer absorb rising costs and falling demand, job cuts accelerate rapidly. Historically, unemployment rises sharply after long periods of apparent stability, not gradually. This sudden shift often catches policymakers and households off guard. Labor market strength therefore reflects past conditions rather than current momentum. By the time employment weakens, the downturn is already well underway. Relying on jobs data alone to judge economic health is risky because it masks emerging stress in profits, investment, and credit. The lag effect turns labor markets into a delayed warning system, flashing red only when damage has already spread. Understanding this timing helps explain why calm labor headlines often precede economic slowdowns, rather than prevent them. If labor markets are reflecting the past instead of the present, what other indicators are quietly signaling trouble ahead? Financial markets often reinforce the illusion of stability because they respond to expectations, liquidity, and narratives more than immediate economic fundamentals. According to the Federal Reserve and IMF, markets can remain calm for long periods even as risks accumulate, especially when investors believe central banks will step in if conditions worsen. This belief, sometimes called the policy backstop, encourages risk-taking and delays repricing. Low volatility does not mean low risk. It often reflects confidence that future problems will be managed. The Bank for International Settlements notes that abundant liquidity and passive investment flows can suppress market signals, keeping asset prices elevated even when growth slows. Reuters. Reporting highlights how equity markets frequently peak months before recessions begin, not because conditions are strong, but because expectations lag reality. Corporate earnings also adjust slowly. Companies use accounting flexibility, cost-cutting, and guidance management to smooth results, masking pressure until it becomes unavoidable. Credit markets provide another lag signal. Spreads often remain tight early in downturns because defaults take time to emerge and investors chase yield. Once stress appears, spreads widen rapidly, triggering abrupt market adjustments. Housing and commercial real estate behave similarly, with prices staying high until transactions slow enough to force repricing. These delayed reactions make markets look resilient while vulnerabilities grow. The danger is that calm markets encourage policymakers and households to underestimate risk. When repricing finally occurs, it feels sudden and excessive, even though conditions had been deteriorating for months. Market stability, therefore, is not proof of economic health. It is often a reflection of delayed recognition. The lag effect explains why financial crises appear to erupt out of nowhere. In reality, the warning signs were present, but they were buried beneath confidence, liquidity, and belief in intervention. If markets stay calm by looking forward while the economy weakens underneath, how late is too late to react when signals finally change? Rising debt levels are one of the most dangerous lagged risks in the global economy because their impact unfolds slowly and unevenly. Governments, households, and corporations accumulated record levels of debt during years of low interest rates, creating the appearance of stability through easy financing. According to the IMF and World Bank, high debt does not cause immediate crises when borrowing costs are low and growth is steady. The problem emerges later when conditions change. As interest rates rise or growth slows, debt servicing burdens increase, reducing spending and investment across the economy. This adjustment rarely happens all at once. Instead, pressure builds quietly as budgets tighten. Refinancing becomes harder and defaults rise gradually. The Bank for International Settlements notes that debt overhangs reduce economic flexibility, making economies more vulnerable to shocks and less able to respond with stimulus. Reuters. Reporting highlights that governments are already spending more on interest payments than on key public services in some countries, crowding out productive investment. Corporate debt shows similar dynamics. Firms that borrowed heavily to expand or buy back shares now face higher refinancing costs, forcing cost-cutting and delayed investment. Households feel the lag through higher mortgage payments, reduced access to credit, and declining purchasing power. These effects accumulate over time, weakening demand without triggering an immediate collapse. Debt acts like a slow-release constraint rather than a sudden shock. By the time stress becomes visible in defaults or fiscal crises, economic momentum has already eroded. This explains why debt-fueled expansions often end not with a bang, but with prolonged stagnation. The lag effect allows debt vulnerabilities to grow unnoticed during calm periods, only to assert themselves when the system is least prepared. Stability built on leverage is fragile, and the longer adjustment is delayed, the harder it becomes. If debt pressure builds quietly while growth looks fine, how close is the global economy to hitting its real limits? Global trade and supply chains are another area where the lag effect distorts the true state of the economy. After major shocks such as pandemics, wars, and sanctions, trade does not reset instantly. Contracts, shipping routes, and production networks are slow to unwind, giving the impression that global commerce is holding up better than it actually is. According to the World Trade Organization and UNCTAD, trade volumes often remain stable in the early stages of slowdown because firms continue fulfilling existing orders and running down inventories built during stronger periods. This masks weakening demand until new orders decline sharply. Reuters reporting shows that many exporters are now facing softer forward bookings, even as headline trade data looks resilient. Supply chains also absorb stress unevenly. Large firms with diversified networks adjust slowly, while smaller suppliers feel pressure sooner through delayed payments and canceled contracts. The IMF notes that trade fragmentation driven by geopolitics further complicates adjustment, as companies prioritize political alignment over efficiency, raising costs without immediately reducing volumes. Over time, these higher costs squeeze margins and reduce competitiveness. Shipping rates, port activity, and logistics investment tend to adjust with a delay, reinforcing the illusion of stability. Once inventories normalize and contracts expire, trade flows weaken more visibly. This delayed adjustment explains why trade downturns often appear sudden even though demand has been slowing for months. The lag effect in trade means that current data reflects past decisions rather than current conditions. By the time trade indicators turn negative, the slowdown is already well advanced. If trade data reflects yesterday's decisions, how much weaker is global demand than current numbers suggest? Housing markets play a critical role in shaping economic cycles, yet they respond to stress with long delays that make downturns harder to detect early. According to the Bank for International Settlements and OECD, housing is one of the most interest rate sensitive sectors. But its adjustment process is slow because transactions are infrequent and prices are sticky. When borrowing costs rise, activity slows first as buyers step back, while prices often remain elevated due to limited supply and seller resistance. This creates the illusion that housing is stable even as affordability collapses. Reuters reporting shows that construction activity, mortgage applications, and home sales usually weaken months before prices adjust, signaling underlying stress well ahead of headline indices. Developers delay projects, households postpone moves, and credit conditions tighten quietly. The Federal Reserve notes that housing downturns affect the broader economy through wealth effects, employment in construction, and reduced consumer spending. However, these channels operate with lags, meaning the full impact arrives well after policy changes. When prices eventually soften, the adjustment can be abrupt, triggering negative equity, tighter lending standards, and reduced confidence. Because housing is closely tied to household balance sheets, its delayed correction often marks the transition from slowdown to deeper stress. The lag effect explains why housing booms feel durable until they suddenly aren't. Stability in prices reflects past demand and supply constraints, not current affordability or future risk. By the time housing clearly weakens, other parts of the economy are already under strain. Housing does not cause downturns alone, but it often confirms that the lagged effects of policy and debt have finally reached households. If housing is the last sector to adjust, what happens when households finally feel the full weight of economic pressure? Governments often respond late to economic slowdowns because fiscal and policy data is also distorted by the lag effect. According to the IMF and OECD, government revenues tend to remain strong even after growth begins to weaken, since tax receipts reflect past profits, wages, and consumption. This delay gives policymakers a false sense of security, encouraging them to maintain spending or delay adjustments. Reuters reporting shows that many governments continue expanding budgets based on outdated growth assumptions, only to face sudden shortfalls when revenues finally decline. Fiscal tightening, when it arrives, often coincides with weakening private demand, amplifying economic stress instead of smoothing it. Political incentives further worsen the delay. Governments are reluctant to acknowledge downturns early because doing so carries electoral and social costs. As a result, policy responses are often reactive rather than preventative. The World Bank notes that by the time fiscal stress becomes visible through rising deficits or debt ratios, economic momentum has already slowed significantly. Emergency measures then replace gradual adjustment, increasing volatility. Central banks face similar challenges when coordinating with fiscal authorities, as policy timing becomes misaligned. The lag effect means governments are often managing yesterday's economy rather than today's conditions. This misalignment reduces policy effectiveness and increases the risk of overshooting, either through excessive tightening or delayed stimulus. The outcome is a cycle where policy actions arrive, just as conditions are changing again. Government response is therefore not slow because of ignorance, but because the data they rely on arrives late. Understanding this helps explain why policy mistakes are so common during turning points. If governments are always reacting to the past, can policy ever truly stay ahead of economic cycles? One of the most dangerous consequences of the lag effect is that global risks remain mispriced until stress becomes unavoidable. Financial systems, businesses, and governments often base decisions on current stability rather than future vulnerability. According to the IMF and the Bank for International Settlements, risk pricing tends to be backward-looking, relying on recent volatility, default rates, and growth data that reflect past conditions. When those indicators look calm, risk premiums stay low, encouraging leverage and exposure. Reuters reporting shows that periods of low volatility often coincide with rising hidden risks, as investors underestimate how quickly conditions can change once lags unwind. Credit markets are particularly vulnerable. Defaults remain low early in slowdowns, masking deterioration in borrower quality. Once refinancing pressures hit and cash flows weaken, defaults rise sharply and spreads widen abruptly. The Financial Stability Board notes that interconnected financial systems can amplify this shift, turning localized stress into broader instability. Insurance markets, pension funds, and shadow banking institutions also adjust slowly, holding assets priced for stability long after conditions have changed. This delay creates a false sense of security that encourages further risk-taking. By the time markets reprice risk, the adjustment is sudden and painful. The lag effect explains why crises often appear to erupt without warning, even though vulnerabilities were building in plain sight. Stability in risk pricing reflects delayed recognition, not genuine safety. When perception finally catches up with reality, the correction overshoots. Understanding this dynamic is essential to understanding why calm periods often precede sharp global shocks rather than prevent them. If risks stay underpriced until the moment they explode, how prepared is the global system for the next sudden repricing? The reason economic crises often feel sudden is not because they emerge overnight, but because the lag effect hides pressure until adjustment becomes unavoidable. For long periods, households, firms, markets, and governments operate based on conditions that no longer exist. Growth appears steady, jobs remain strong, and markets stay calm, creating confidence that risks are under control. According to the IMF and OECD, by the time multiple lagged pressures align, higher debt servicing, weaker demand, tighter credit, and declining investment, the economy reaches a tipping point. Once that point is crossed, responses accelerate rapidly. Firms cut jobs instead of hours, banks tighten credit instead of monitoring risk, and governments shift from gradual adjustments to emergency measures. Reuters reporting shows that this clustering of delayed reactions makes downturns feel abrupt, even though the causes were developing for years. The World Bank notes that this dynamic is especially dangerous in a highly leveraged global system, where small shocks can trigger outsized responses once buffers are exhausted. The lag effect also explains why early warnings are often ignored. Signals appear disconnected and manageable until they converge. When they do, confidence breaks quickly. Understanding this pattern does not eliminate cycles, but it improves awareness of vulnerability during calm periods. Stability should be treated as a phase, not a guarantee. The global economy rarely collapses at the moment of shock. It breaks when delayed consequences arrive all at once. Recognizing the lag effect helps explain why economic calm is often the most dangerous moment of all. If the most dangerous phase is when everything looks fine, how should economies prepare for risks that haven't surfaced yet? For clear, data-driven explanations of how global systems really work, stay with Wealth Woven and keep looking beyond the headlines.